Good afternoon, everybody. Thanks for joining us live and in recording. It's Ilona and Zoria. We are back with our weekly lives.
Hi, everybody.
And it's Multifamily Her Lives, which we do every Saturday at 1 o'clock Mountain Standard Time. Well, some Saturdays we skip. It just, life happens, but we try to be consistent. And here we are.
Yeah.
And today we actually wanted to start with an announcement. Zoria, did you want to do an announcement?
Sure. So today, in an hour, we have our in-person meetup. It's the InvestHER Meetup. So it's for anyone, mostly women interested in real estate. It's just a supportive group environment that you can ask your questions. And so it's in Edmonton at 2 p.m. And so if you're still interested in coming, you can come. And we're going to have a special guest today, a realtor who's also an investor. So she will be able to answer all your questions about the market, what's going on.
I mean, why wouldn't you want to come? It's raining outside.
Yeah.
Come join us.
Yeah, we were supposed to be on the patio, but we'll be inside instead because it's raining.
Sipping warm drinks.
But maybe more people will come because their plans got canceled.
Yeah. And I mean, we're going to be talking real estate. What else would you want to talk about on any day, and especially on a rainy day? So come join us, guys. We would love to.
What else do you have to do?
Yeah.
Yeah. So,
all right. So today, we have a very interesting topic today, guys.
Yeah, so today we want to talk about just the basics of syndications, and obviously first just explain what that is even.
Yeah, it's so fancy. Zoria, tell us what is a syndication?
Yeah, so a syndication, and really just as a fancy word for a group investment. And so instead of taking your own money and buying something and purchasing, say, a single family home, so you pool your money together with other investors and other real estate professionals, and you buy a property together. So it's the same thing as if, a group of people wanted to chip in and buy some pizza. You just don't want.
Except you're buying real estate.
Yeah, except you're buying real estate. It's just like when you're going around the office, who wants to chip in a bit of money? And to have a pizza party. So it's the same thing.
I like it, a real estate party.
It's just a real estate party. And that allows you to buy something bigger that you may not be able to buy on your own. And usually bigger assets come with more economies of scale and usually better returns. So it can be hard to buy an apartment building on your own. Mm-hmm. So then you'll have the sponsors or the operators are the active real estate professionals that they're involved in the acquisition process and executing the business plan. They basically are doing all the work. And then the passive investors, they just invest their money. So we're talking today more about from the perspective of a passive investor, how does this look like? And then basically everybody and then takes their split of the profit.
Yeah, and these terms, operators, sponsors, I feel like they come to us from the US multifamily.
It is a lot more common to hear that in the US. I think in Canada, the more common term you'll hear is general partner, especially if it's set up as a limited partnership, which is the most common way to do it. Otherwise, you might see it set up as a corporation, and then the active partners are just, the active shareholders, and they have the voting shares. But typically for these larger syndications, you'll see it as a limited partnership. So then the operator or the sponsor or the active investors, they basically all mean the same thing. It means the general partner, the group. It can be one person or it can be a group of people who are basically have the experience to make those decisions. And they're the ones that take care of all the work. They vet all the deals. They find the deals. They negotiate the deal. They do all the due diligence, visit the property, do the inspections, involved in all of it. And they involved in purchase the property and managing the property and then selling it or refinancing it later.
And let's talk about then, so the usual structure of it. in I guess, do you want to talk about it in the Canadian, or I guess it's very similar in the US context as well, the LPGP structure and what the responsibilities and risks are.
Yeah, that's a good point. Yeah, so it's very similar in the US and Canada, or if or as a Canadian investing in the US, it's very similar. So a limited partnership, or you'll probably hear it more commonly, LPGP. And we've talked a bit about this before, but so the limited partnership is made up of the limited partners and the general partner. And so, like I said, the general partner, those are the people doing the work. They also have the liability. And the nice thing about this is that the general partners can have a smaller portion of ownership. They could have like 20 or 30% ownership, but still have 100% liability. So as a limited partner, like as a passive investor, that's what you want to see, because you don't want to be taking on any liability for their decisions, right? So even though they have a smaller ownership, basically a smaller portion of the profit, in the end, they still take 100% of the liability. So that's good for the passive investors.
The general partners take 100%.
The general partners take on all the liability. Yeah.
That's why it's called limited partner. Your liability is very limited.
Yeah. And that's why you're called a limited partner, because your liability is limited. Literally, you're only limited. The worst case is you lose your investment, but you're never going to be, the bank or anyone else is not going to be coming after you for more. You're not liable for anything else.
And I wanted to ask, so Zoria, like usually these type of structures, we see them in multifamily space. Mm-hmm. I mean, just out of curiosity, I haven't looked too much into commercial space. Do you know if they also use similar structure like GPLP?
Yeah, it's a very common structure in order to buy larger assets. And so it can be commercial assets, which can be multifamily, it can be industrial, it could be storage facilities, mobile home parks, office space. Yeah, I think it's common to have the same structure for all of those types of assets. It's not just limited to multifamily, but
makes sense. Yeah,
we're talking in the multifamily box today.
Yeah. Yes.
Yeah. And so as far as, you're limited in your liability, also limited in, as a passive investor, limited in your responsibilities. Like there's no responsibilities. Yeah.
Can I pause here? So guys, if you have any questions, like drop them in the comments and we'll try to answer them. Today's live will be kind of short, but we'll try to get your questions if you have any.
Yeah.
All right.
So does that make sense? Like kind of those are the two main components or people involved, and those can be, that's a group of limited investors or limited partners, and there could be the group of general partners.
So now a question that we usually get is who makes decisions, how decisions are made, and how limited partners participate in those decisions, and what general partners do. Is there a consultation process? Like what's a normal process for that?
Normally, it's the general partners that are making the decisions because they're the ones that are liable and responsible for those decisions. If a passive investor wanted to be involved in the decisions, then you're also going to be taking on some liability as well. So you basically have to be like one or the other. You're passive and you don't make the decisions, therefore you don't take on any responsibility, or it's the general partners. Like if it comes to a really big decision, it doesn't mean that the limited partners won't be consulted. Like, whether we should like sell a building or refinance, like I think a good general partner would, take the initiative to have, a general meeting with everybody and get everybody's kind of idea. Because you don't want to just do something opposite of what all the limited partners want to do, because that's not going to make anybody happy, right? Yeah. So I think a good general partner like takes, finds out what everyone kind of wants to do, but ultimately it really is only the general partner's decision.
That leads me to another point, and another question is, you basically, as a passive investor who who would be interested in limited partnership, you would need to be carefully screening and picking your general partner who you trust to make those decisions, right?
Exactly.
And who you would trust that they would come to you when major decisions about the investments are made.
Yeah, exactly.
Do you want to talk today about screening your GP, or that's like a topic for another day?
Yeah, that's another topic. That's another like big topic of how to kind of decide and what kind of background checks and stuff you should do. Yeah, let's leave that to a different day.
Yeah.
I wanted to just kind of stick to kind of like the basics. And so another thing about, just about the limited partnership, it's basically it's also a pass-through. So like unlike a corporation, which a corporation is almost like creating a new person, and that person has to do their taxes. And a limited partnership is just a pass-through. So all of like the profit and like tax advantages get flown through the limited partnership to the individual owners, or all the limited partners and all the general partners.
Mm-hmm.
Don't get too much into that, but that's one difference between that and a corporation. And you're not owning shares, you're owning units. You own units in the limited partnership. So yeah.
So what else? Do you want to talk about the return on investment?
The types of returns that you could get in this type of structure. So every syndication is different, but and they'll offer their own like returns. But basically, there's two main types. There will be like the cash flow distributions, and then there will be like profits from a sale or a refinance. So typically, a syndication will have like some sort of preferred return or like cash on cash return. And that's something you can more expect on like a quarterly or maybe monthly basis. But then there will be like a larger profit, once the property is sold or refinanced. And so if someone's not familiar with a preferred return, so say it's like a 6% preferred return, that means like out of all the profits, or if there's any cash available, then 6% will go to the investors first. So if you invested $100,000 into something, then you get $6,000 a year. That's preferred because that has to be paid out first before any other profits are split between.
So is it the same thing as guarantees, preferred, or no?
I don't believe it's the same as guaranteed, because we definitely don't call it a guaranteed return, but it's preferred.
So preferred in case there is return.
Yeah, like if there's no profit, then you don't get anything. When there is profit, then that's preferred. So it goes first. Basically means first to the passive investors. But yeah, if there is no profit that month, then nobody gets anything.
And then what happens? So like the investors get their preferred return first, and then what happens to the rest of the profit?
Then the rest of it, there's usually a split. Some sort of split, 60-40, 70-30, 80-20. So it's usually the smaller amount goes to the general partners, and then the larger amount goes to the passive investors. So that's a really basic structure. And so you can kind of, I don't want to say again guarantee, but like it's a little bit, you'll have kind of that more consistent. Once, returns start, you'll have that preferred return, and then you'll get the majority of your capital back likely when there's more of a capital event, like a refinance or a sale. And so that's the other type of profit. And usually in a syndication, you'll hear like what the operators, like the general partners, are expecting as a profit, like once they do carry out the business plan. And one term that you might hear is equity multiple. And maybe it's to keep it simple. An equity multiple, it just means like, so a 2 times equity multiple means you're going to double your money. And so instead of saying like 100% return or 200% return, it's almost easier just to do a 2 times. It means 100,000 in means by the end you'd you expect you could get 200 out.
You specify the timeline, right?
Yeah, like the syndicator should be specifying how long that should take to double it. So,
and if they don't, always ask.
Yes, yeah.
Because there is a difference, like 10, what is it? 10% return over 10 years or 10% return in a year.
Yeah, huge difference.
Yeah.
So just like this, like a 2 times equity multiple is basically like a, now I get confused, 200% return, right? So yeah, is that over 1 year, 2 years, 5 years, 10 years? You want to know that part. So typically it's somewhere in between like 5 to 10 years, like especially in multifamily, where typically it takes a bit of time to, buy the property, do something with it, and then get a profit. Right? It does, unless the syndicators are buying something that doesn't need a lot of work, and they're just going to buy it and it's going to just cash flow from day one. Then it'll be a bit different. Maybe you'll have more cash.
Just stabilize the property a bit.
Yeah. Similar to the new builds that we're buying, for example, like there's basically cash flow from day one. You're not, there's not going to be a huge increase in value that we're not forcing the appreciation in any way. It's already like a Class A building. We're not going to just, refinance it in 2 years and then at a higher amount. So, but on the other strategy where you're actually buying something that's a little bit more distressed, older, the typical strategy there is to buy it, renovate it, increase the value, and then refinance. So to do that, it takes a few years.
Yeah. Uh-oh. I have somebody by the door. Sorry if you guys hear it. Nothing didn't happen today, so my kid is upset.
Yeah. So that's kind of what we wanted to go through today. I also wanted to mention that this is actually like a sneak peek into like a mini course that I'm putting together that will be free in the future, but I haven't finished putting it together yet, but this is part of it. So this is just a sneak peek into what I'm putting together.
And Zora, do you want to mention how to subscribe to it? Or I guess we can announce it once it's ready.
Once it's ready, it'll be on my website. But right now it's not yet. So.
Okay, well, it's our InvestHER in-person meetup happening shortly, so we're gonna wrap this live up. And if anybody has any questions about syndications or LPGP in the context of syndications, drop us comments under one of our videos and we'll get your questions.
Yeah. I enjoy educating people on this topic because it's not as common knowledge. So and I think the reason is because it can actually, if you do know that this opportunity exists, then you can take advantage of it, right? If you don't even know that a syndication is a thing, then you won't be able to be involved in one.
Yeah, so many different great opportunities to be involved in real estate, which I'm very excited to share with you guys and provide knowledge and education on the topic.
Yeah.
All right.
Well, thanks everybody for joining.
Yeah. Take care.
See you next time.